Hi, and welcome to this week's look back at the major news stories that have impacted the market so far. And we're going to start with inflation being back at the top of the agenda as the euro slumps. Now, Christine Lagarde, the president of the European Central Bank, has publicly stated that inflation is a monster that we need to knock on the head. Now, that's no great surprise, but the central banks seem to be focused on purely interest rates to control this rampant inflation. That does cause issues for individuals, of course. People who have mortgages are seeing their mortgage payments going up. House purchases are on the decrease, obviously the same obvious reasons. Now, there's already dwindling disposable income across a lot of Western economies due to, various other factors, the cost of living, increases in fuel and energy bills, for example. Now, Lagarde said to the press in Spain this week that they're not seeking to break the economy with rate increases, and she's appealed to the banks to reschedule debt repayments for those that are already struggling. Now, obviously they need to do something, but this is coming at a cost to the individual, and the rhetoric that's being currently used doesn't seem to indicate that it's going to stop anytime soon. We've seen the euro almost at parity, currently around the 105, 106 mark. US inflation has fallen to 7% from double figures in the last few weeks and seems to be retracting much quicker than Europe and the UK. Now, obviously that means that US-based multinationals have to pay more to operate European subsidiaries, but the US domestic economy appears to be settling, and the depreciation of their currency against everyday life expenses is nowhere near the same impact as European or British levels. So volatility is in the air for the euro and the pound too, which is languishing, I think we could say, around the 119 mark, a little bit lower earlier in the week. But it's clear that a lot of the central banks and a lot of what's being said is to give us indications that the battle against inflation may well be longer than we first feared. Okay, secondly, we're going to flip across the pond, as we like to say, and look at how Powell has accelerated the bullish trend on the dollar index. Now, Jerome Powell was speaking in Congress on Tuesday of this week, and he said the Fed is ready to return to more significant increases in interest rates to fight inflation. Now, it obviously started off with, 50 basis points increases, and recently that's been dropped to 25. Powell also said the final level of the interest rate is likely to be higher than previously expected. He also said recent economic data was stronger than expected, and if that data set indicated the need for faster tightening, the Fed would dare to do so. Powell's comments were roughly in line with those that we've mentioned briefly from Christine Lagarde, President of the European Central Bank. What actually happened? Well, against these background comments, we saw the stock market experience a non-recoil drop in quotations. Top of that, the price of gold went down, and the futures for the dollar index reached the highest since the start of this year. If we have a quick look at the chart, we can see the forming of a breakdown of the important resistance that's labelled 1 at 105.5. Now, it's possible bulls may try to gain a foothold at these achieved highs. And if market participants increase their expectations, because, a lot of people were thinking things were going to slow in terms of tightening, but they increase their expectations of a longer and tougher policy, could we see new highs in the coming week? It's fair to say inflation is a major factor at the moment, and it's fair to say that is also driving volatility. Thirdly, we're going to take a look at what's quite a significant story actually this week, and that's the Swiss National Bank, or SNB, reported a record loss. In fact, they reported an annual loss of 132.5 billion Swiss francs, by far the largest loss in its 115-year history. But why? And obviously, quite importantly, why? There's been a fall in the value of the SNB's investments due to a decrease in both the bond and stock markets in 2022. Not a massive surprise. Secondly, at the same time, we did see a little bit of strengthening of the Swiss franc, which obviously has an effect on the value of their foreign investments once converted back into Swiss francs. So what's going to happen moving forwards? Well, on March the 23rd, the SNB monetary policy decision is announced. And at the moment, there's been no comment whatsoever from any of the members whether this SNB loss will affect their decisions one way or the other. Now, unusually, the Swiss franc, against this backdrop of quite negative news, was up. But it was probably more likely to be linked to the expectation of the Fed Powell's speech and what was actually said in that speech. If we have a quick look at the chart, we can see the longest shadows labelled 1 that are forming when the price drops below the support level, which is labelled number 2. And that may well indicate the presence of demand. But it's fair to say this is pretty chunky news of a huge loss for a central bank that probably wasn't expected to be quite that bad. So interesting markets at this time, that's for sure. Okay, and finally, we're going to take a look at an equity, and one that's often in the news for obvious reasons, and that's Apple. And Apple shares have actually been given a buy rating by Goldman Sachs. Now, obviously, Apple's largest capitalisation in the US. There's been a lot of media broadcasting with bullish news recently on Apple stocks. Now, NTS CEO Share Wang says that Apple plans to release a mixed reality device this year at some point, and that Apple's gearing up for a new line of laptops and desktops, including a new iMac, which is pretty much in the public domain. Off the back of a lot of this sort of bullish news, and obviously their own analysis, Goldman Sachs set a buy rating with a target of $199 just earlier this week. Now, also off the back of this pretty positive news, Apple shares were up. In fact, earlier this week, they were the top gainer for the day. If we have a quick look at the chart, there's a bullish gap formed on that chart, and the price at the high of the day is very close to the high of 2023. Again, a positive sign. We do see decrease in volumes, that's labelled 1, against a price decrease in the second half of February, and that may indicate a lack of supply. But that lack of supply could be because traders are holding on to what they now consider to be a very promising stock. Could be the case. So can the forces of demand kick back and overcome the trend line, that's labelled 2 on the chart, which currently does seem to work as a resistance level? It's difficult to say, but if we take a look at a range of analysts and take their average price, say for a forecasting price for 12 months from now, the average comes out at $171, which again, bullish, positive news for Apple stocks. Obviously, a lot of talk over the last 12, 18 months about tech stocks, but it certainly seems to be that Apple may well be benefiting from a new bullish trend. We wish you luck with your trading in the week ahead. Bye for now.